Hello and welcome. This is Andy Michael with Seven Springs Wealth Group. The Fed just recently had their last and arguably biggest meeting of the year this week, and we want to quickly summarize the Fed's view of the economy, their decisions, our takeaways from that meeting, and the risks and actions that we see going forward into 2022. The Fed's economy view is that the economy is strong today, and the economy is going to be strong tomorrow. Their 2022 projections for GDP is 4%, and the unemployment projection is 3.5%. So that would still be a very strong economy next year on the backs of a strong economy this year. They're also suggesting that the labor market is stronger now than it was even pre-COVID, and the data is there to support that. There's currently 11 million job openings. The unemployment rate today is only 4.2%. And we're even seeing that there's fewer unemployed people per job openings now than there were back in pre-COVID times. They're also saying that inflation is running higher, longer, and more broad-based than they once thought. They have now taken out the word transitory. I think that word has been retired in 2021. Expect to hear that a lot less in 2022. And we saw that CPI's recent inflation rate was 6.8%. So the Fed is now acknowledging that inflation is a real issue that they're going to need to address. And so what were the results of that meeting? If we go back to the Fed's mandate, it's very, very simple. Maximum employment and price stability. We have one in maximum employment. We definitely don't have the other in price stability. So what are they doing about it? They're going to double the rate of the taper that they started. It's now going to end around March instead of in June. And they're projecting 3 rate hikes in 2022. All of this is more aggressive monetary policy than what we saw from their last meeting. So they have absolutely taken a pivot, and they are making an adjustment from what they were initially setting out to do just a couple months ago. So what are our takeaways from this Fed meeting? Number one, they have set a roadmap for 2022. That provides the market some clarity. At the end of the day, the market loves having uncertainties removed, or at least thinks it likes to have uncertainties removed. And so having this map of the taper ending in March, 3 rate hikes being projected, that gives the market an idea of what to expect going into 2022. The Fed is also telling us that they see the strong economy and the inflation being a greater concern than the Omicron risks. So even though COVID is still a very real risk to our health and the economy, the Fed is telling us through their actions that they are more concerned about the high inflation prints that they're seeing now than the potential for the economy to shut down or slow based on any type of COVID variants out there. Number 3, the Fed is still accommodative. I think this is very important to remember as they're getting tighter, but yet still being very, very accommodative. If they do, in fact, get to zero taper by the end of March, and have 3 rate hikes at the end of 2022, that means we would still be in a negative interest rate environment at the end of 2022. They're projecting 2.6% inflation. They're suggesting the federal funds rate would be at 0.75%. That still leaves a negative real interest rate of nearly 2%. That would keep people still invested in risk assets when that negative interest rate is still negative. So still accommodative is the takeaway from that. Most importantly, number 4, they're subject to change. All of this is data dependent. We've seen it with Chairman Powell twice now. Once in COVID, they quickly responded, cut interest rates to 0, flooded the system with cash, and now we're seeing it again. Inflation has been stickier than they thought. They are changing their trajectory. So they have shown that they are willing to pivot when the data is not supporting what they initially thought. And so that means even the projections that they've given us this week are absolutely going to be data dependent and subject to change. So don't get this roadmap too stuck in your mind. They are certainly going to be evaluating it each meeting as the data continues to come in. So the Fed forecasts of 4% GDP growth, 3.5% unemployment, and 2.6% inflation for 2022. That sounds very rosy to me. Let's talk about some of the risks to that and what we can do about it if it doesn't come out as rosy as the Fed is suggesting. First off, what if the Fed can't contain inflation? This inflation is probably more fiscally driven this time than monetary anyway. When the government sent out checks to everyone at the same time, that we're having supply chain issues that drove up prices. So this wasn't necessarily completely Fed-induced inflation in the first place. So it may not be Fed contained either. And so what do we do if we can't contain inflation? We want to continue owning cash flowing businesses and real estate. We still think those are two of the best hedges to inflation over the long run. What if growth is actually softening? What if families are starting to say, instead of making that next big ticket purchase item or doing that huge home improvement project or buying a home or car, what if I just need to focus on paying the 20% higher prices at the pump, at the groceries, my utilities, and now I can't do some of those purchases that I thought I wanted to do before. So if we have some of that growth softening, I think it's really important to continue to practice diversifying. That could be owning international equities. Global economy is not doing exactly the same things that the U.S. economy is doing. It's also important to own those preservation and income outcome buckets that we continue to talk about, diversifying just our growth bucket. What if we see financial stability wavering? These were Chairman Powell's words in the press conference this week. He sees asset valuations still somewhat elevated, and he sees crypto speculation not being a financial stability concern. So we could see some financial stability wavering, and we could see some of these assets that really increased in price without having the fundamentals behind them see a lot of significant volatility. Already seen that, could continue into the future. What are we doing about it? We are owning high quality, reasonably valued businesses. We think this is a really important time to know what you own, know that the profitability is there. I think that's going to be really, really important as we do go into a tightening environment, and some of the conditions that allowed some of these very speculative assets to do very, very well could get reverted to the mean. And always, finally, what if there's a black swan event? COVID's a great example. What if there's just something out there that we just can't forecast? The Fed can't forecast black swan events. We can't forecast black swan events, the unknown unknowns. Again, it's always critical to have that financial plan, have your emergency savings in place, have some flexibilities in place like a line of credit. Again, just having those tools in the toolbox are very, very important for that black swan event, the unknown unknowns. So this is our last video for the year. We want to wish you and your families a very, very happy holiday season. And here's to a healthy and prosperous new year. Thank you again so much for watching, and have a great day.